Hello everyone, welcome back. So here I am going to explain about the concept of break-even analysis. So here the break-even analysis is very important concept for the management to determine the profit or loss positions. So we will discuss the concept. So what is the meaning of break-even analysis? Break-even analysis is of vital importance in determining the practical applications of cost functions. Means whatever the cost functions we are having, that can be easily studied through the break even analysis. Under break even analysis, we'll go for studying about the sales volume, cost and profit. These three things will go for studying under the break even analysis. So it is also called as cost, volume, profit analysis, because we will study these three things: cost, volume and profit. And the break even analysis is useful to determine when your business will recover all your capital expenditure and when it begins to make the profit. So that is also determined from the break even analysis. And the break even analysis helps to know the operating condition that exists when the break even point. So means whenever the company reaches to break even, so what will be the operational condition of the company, that can be determined. So break even means the point at which the cost is equals to total revenue. And the concept will be helpful for the profit forecasting and also for the future planning. It also helpful in examining the effect of alternative business decisions to the particular cost, volume and profits. And so here we'll go for discussing majorly three main contents under break even analysis. They are break even point, determination and uses of break even. And break even point means the point at which the total cost is equal to the total sales revenue. The point will be called as the break even point, where the situation will be no profit and no loss situation. Means whatever the capital involved or the cost incurred by the company, the cost is equal to the profit, total sales revenue, then the point will be called as the break even point. If the total output falls below the break even point, then it will be said as the loss situation. And if the output exceeds the break even point, then it will be said as the profit position for the companies. So thus break even point is the minimum point of production where the costs are recovered by the company. And break even point we can determine in two ways. So break even point in terms of physical units, that is the total volume of outputs, and break even point in terms of the money value, that is what is the total sales value we can get from the from the particular sales volume. So in both the ways, that is break even point in physical units and break even point in terms of sales value, both the ways we can go for determining the break even point. And now we will see the break even chart. So the representation of various concepts like total fixed cost, total variable cost, total cost and total revenue, which we will represent in a graphical format. Then the graphical representation of all these concepts will be called as the break even chart. So break even chart shows that what is the extent of profit or loss a company is getting at different levels of activities. So different levels of activities means different quantities of production. For each and every quantity of production, what is the profit or what is the loss a company is getting, that we can be shown through the break even chart. Means all these concepts will be represented in the graphical format. From that we can know what is the extent of profit or loss. So this is how we'll go for representing the break even chart, that is output on x-axis, total cost on y-axis, and we'll go for representing total income, total cost, variable cost and fixed cost. So the point at which the total cost and total income touches, that is called as the break even point. And what are the assumptions of break-even analysis? The first and foremost is whatever the total cost you are having, that should be divided into fixed and variable components. And the second one is the fixed cost should remain constant at all volumes of output. Even though the volume is changing, the fixed cost should not be go for changing. That is the second assumption. And the third one is the variable cost will fluctuate in direct proportion with the volume of output. If you are increasing volume, the variable cost increases. If you are decreasing the total volume, then variable cost will also decreases. And the next one is selling price and product mix will remain constant, and the number of unit of sales should coincide with the units of produced. Means whatever the units you should be sold, that should be equal to the units of production. Then you will be not having any opening stock and any closing stock. And productivity per worker will also remains constant, will not go for giving any additional productivity, and there will be no change in the price levels. And the next is uses of break-even analysis. So the break-even analysis helps in determining the selling price of the desired profits. If you want to get a desired profit, what will be the selling price at which you have to sold the product? And the second one, it helps in fixing the sales volume at which your capital will be getting back to your hands. And the third one is it will help in forecasting the cost and forecasting the profit according to the changes in the volumes. So, and it gives suggestions for shift in the sales mix. It helps in making inter-firm comparison of profitability. You can also go for making the comparison from one firm to another firm in way of profitability. What is the profitability of our company and what is the profitability of our competitor or another firm who is present in the market? So this can also be done through the break-even analysis. And the next use of break-even analysis is it helps in the determination of cost and revenue at various levels. If you are changing the total volume of production, at each and every volume of production, what will be the total cost and what will be the total revenue, that we can determine. And it is one of the aid for the management to take the decisions like make or buy decision, and it will be helpful in forecasting, making long term planning, and maintaining profitability. For all these things, the break even analysis will be helpful and it can be used as a technique. And the next one is it reveals business strength and profit earning capacity of a concern without much difficulty and effort. Means without having the complexity or without having any difficulties, we can go for identifying what is the strength of the business and what is the earning capacity of particular concern, so without having any difficulty. So these are all the about the break even analysis.